Ladies and gentlemen, I am pleased to announce our fourth session on risk and compliance, embracing for emerging risk and regulatory complexity. I am pleased to invite the panelists to the dais. Mr. Rajiv Savarwal, MD and CEO Tata Capital, Mr. Sudipta Roy, MD and CEO L&T Finance, Mr. Gaurav Gupta, CEO QNB India, Mr. Parag Bise, Executive Director and CEO Nucleus Software, Mr. Jitesh Khaitan, Head SaaS India. And our moderator for this session is Mr. Hardik Shah, MD and Partner BCG. May I request Mr. Hardik to initiate the discussion? Over to you, sir. I request you all to please take seats.
Good afternoon, everyone. If we can please take the seats. Can I request everyone to take the seats, please? It's working.
I request you all to please take seat. We are starting our session 4.
All right. Good afternoon, everyone. We've got a very esteemed panel and a very diverse set of experiences on the topic of risk and compliance. So we'll get started right away. Gaurav, here I can start with you. You operate in some of the toughest and the high-risk markets in the world. What is your experience, as far as operational risk is concerned? How have you seen the evolution, and what are your top 3 priorities when you look at these markets?
Good afternoon, everybody. First, let me clarify why Hardik calls us operating in some of the toughest markets in the world. So, a lot of you already know Qatar National Bank, but did you know that QNB has now become the largest bank in the Middle East and Africa by all balance sheet metrics? And the bank operates, of course, it operates in Middle East and Africa, but it is also regulated in all the large international financial centers like Singapore, Hong Kong, London, and Paris. Recently, the bank got ranked the world's best bank for emerging markets. And despite operating in all these markets, it has an international credit rating of AA and is ranked amongst the world's safest banks. So it must be doing something right. But when we sit around the table with our colleagues from different countries, I think one of the things we all agree on is the rapid pace of technological transformation. And across countries, settlements are becoming shorter, payments are becoming faster, things are, there's STP, straight through processing, and also because of that, the possibility of propagation of errors has also become real time, right? Because it's easy to now move data and securities and a large amounts of that at very short notice with the improving connectivity. So I think operational risk has become one of the key risks which banks are looking out for. And the 3 which stand out for us the most, the first has become information risk. Then there is the risk of IT disruption. And thirdly, the third-party providers, the third-party service providers. And if you see over the last few years, I mean, how you look at the risks and how you classify them in terms of priority has also changed. Many years ago, the big risk was the risk of theft, whereas now the risk of theft of funds has become a lower order risk. And I think information security is right at the top. The possibility of, especially we talk about AI, and because of AI, it further exacerbates the risk from the cyber risks. Banks around the world, I think the bill for cybersecurity is more than $300 billion of banks around the world. So, the risk of theft of data from the banks, the risk of the data being manipulated, and the risk of data being used for the purpose that it was not intended for has increased significantly. So I think information security risk is extremely critical. The other is, when we talk of, like if you look at especially in the retail sector, as compared to, I spoke about the theft of funds. Now, you compare that, the theft of funds is something that you can quantify, you can insure against it. But what about things like if you're a retail organization and the customers are not able to access their account for 1 week? So I think the risk of IT disruption and the risk of that happening, therefore, is a key risk. One, it causes reputational damage. And secondly, it causes opportunity loss from lost income. And that can be much more damaging than even a theft of funds. Then finally, in terms of, a key risk which has become important this year, and it's escalated in terms of its severity, is the risk from third-party service providers. So as the banks are becoming, banks are of course becoming more efficient, and they're also leaning on their service providers to further enhance the efficiency levels. Then the banks have also increased the standards they expect of their vendors. So, of course, very few vendors qualify for those standards, and more vendors are banking more and more, lesser number of vendors are banking more large institutions. So the data warehousing in a limited number of vendors has increased. So if you look at the cyber attacks in the last 1 year, a lot of, say, the cyber actors, instead of attacking the financial institutions themselves, they will attack the third-party providers who are warehousing a lot of the data from the large banks. So I think these are some of the key risks that we are seeing in the operational risk space.
Many, many great points, and we'll touch upon all of them, especially we've got 2 technology solution providers on the panel as well. But Sudipta, if I can come to you next, from global geographies closer home, you've spoken a lot about how there is a spectrum of risk in the geographies within India, right? And as being the largest small ticket lender in this space, given MFI, two-wheeler, consumer loan, all of these, products that you actually look at, how has your experience been assessing risk amongst different geographies?
Yeah, thank you for the opportunity, Hardik. And one of the things I'd like to say is that, I look at urban risk and rural risk separately. And if I were to sort of, and it always helps if you put it in, 2x2 quadrants. So the way I look at and I classify products as financial services products, I classify as dynamic products. That means products that have high velocity, right? Like payments, or for example, Nodi, a lot of transactions, up and down it's going, or for example, credit cards, right? Which is like a payments with a lending product combined. So I classify that as dynamic products, and static products are primarily loans. They're static loans which you service and amortize over a period of time for the customer. And on the other quadrant, if you have urban markets and rural markets still, especially in India, are not, apart from payments, which is through UPI payments, they're not really capacitized in terms of market maturity to handle dynamic products. So if you see, most of the rural lending that happens is static product lending that is happening. Well, the urban markets are actually capacitized to handle both dynamic and static products. But in terms of the movement of risk or assessment of risk, one of the things that you have to always keep in mind when you are measuring both these markets differently is that urban risks move slowly. Rural risk at some point can move very, very fast, right? Because in the rural areas, you have to keep in mind that when you lend in rural areas, in urban areas, you lend to an individual, right? Or you lend to a max if you're lending to a company or lending to a group of individuals, right? In rural areas, you're actually lending to an individual. If you're doing it individuals, you're actually lending to an ecosystem, right? And sometimes that ecosystem can bring in risks which obviously you do not budget for. For example, when you look at rural lending, for example, we know the largest tractor lenders in the country. And the fact is that the density and the distribution of rainfall have an outsized impact on how the risk on your portfolio pans out. Now, obviously, in rural areas, you have climate risk, you might at times have political risk, right, which is a cloud over your portfolio. And I'll give you, or you might have risks which is like completely out of the blue. And I'll give you an example. A couple of years back, about 4 or 5 years back, MFI portfolio in Orissa specifically, a rumor spread that of the demise of the CEO of L&T Finance. And the fact is that rumor spread so fast that almost close to half of the sort of the villages which were being serviced by us, people stopped paying. But the fact is that that is a risk that you really do not budget for. So I think, when you are underwriting rural customers, especially in the MFI space, in the tractor space, or other rural allied products, I think you have to be far, far more cognizant of the sort of the unforeseen risk that comes out and keep your margin and safety to that extent. And that is why listening posts, what we call listening posts closer to the ground, is very, very important. Urban risks these days, you can run with a lot of data. There's a lot of data available, both the bureaus. Rural risk also now you have bureaus available. But the fact is that the certainty with which you can run urban risk or urban products right now, I think rural products still have a long way to go. And the only way to manage rural risk is to have a data overlay, but have physical overlay. What we call human, in terms of, espionage term. You really have to have human intelligence on ground to actually estimate the rural risk and feed it up the chain. If you don't have that, you will fall into the ditch.
That's a great point, because I think over the years, there is this trend of, how do you increase digitization? How do you get to STP lending and remove the human overlay, right? And Rajiv, if I can come to you, the flip side of, doing more digitization is there is an incidence of application fraud that keeps rising. There are unintended consequences around it. How do you look at this, and what has your experience been on this front?
I think, as lenders, we keep evolving. So do fraudsters. They also keep evolving in this whole journey. And the only thing which I have learned over a period of time is how do you build resilience in your system? How do you ensure that ops risk is managed well? For a long period of time, we have always focused on credit risk as one of the most important risks. And it was true also. But over a period of time, one has realized that ops risk is becoming a significant part of the total risk. And this is the reason, if you would notice, RBI brought in a separate guidelines for NBFCs to bring focus on ops risk and outsourcing risk going forward. All of us moved towards digitizing all our products. Everybody wanted to create digital journeys, ensure that all loans can be given out with, forget low touch, zero touch models. But what one is realizing that, the more digital you make the process, it's very, very important that you build in a lot of controls within those journeys. And if you err on the same, then you make your system susceptible to frauds. There are many ways of resolving it, because I always believe in the long run, creating frictionless journeys is very important. Creating more digital journeys is very important. But how do you parallelly work towards making the, these journeys more risk-free and avoid any challenges? I think one important way is to use the digital infrastructure which has been created within the economy. I think we are still a step away from allowing and treating all entities in the same manner in terms of allowing eKYC. Certain institutions get certain priority in terms of their ability to do eKYC, while other institutions are still struggling to get an okay from requisite authorities to do eKYC. I think some of these anomalies we have to find a way of removing, because infrastructure should be common for all lenders. There should be no differentiation there. How people use it could be different, but ability of that infrastructure to exist for all lenders should exist. Similarly, we have to find a way of seamlessly sharing fraudulent partners, fraudulent entities and information on them, fraudulent employees, and so on. We have to find a seamless way of sharing this information, because allowing for a strong infrastructure to enable KYC, allowing for negative information to be shared, is in the interest of the whole ecosystem. I think if you do that, we will we will end up reducing some of these operational challenges. The other is, I think as lenders, all of us have to think that is there a need to introduce a physical leg in all digital journeys at some stage so that we can avoid people who infiltrate or, bring about interventions in the digital processes. So I think we all need to decide for which product what we need to do there. But if we can create an infrastructure where all available information on frauds as well as ability to do KYC can be common across all entities, it will support the system.
Very interesting. So there's credit risk. We've spoken about operations risk. One other big theme that's emerging, at least in a lot of the countries in India as well, is RegTech. And, Parag, we've spoken about it as a technology solution provider. You help financial institutions be on the right side of compliance or on the side of caution. How do you actually think about the technology infrastructure and the agility with which, FIs can implement some of these regulatory compliances? And what has your experience been?
So thanks, Alec. Yeah, I agree that at least recently the speed of regulatory changes has really increased. Frankly speaking, we did face a struggle initially because one is the speed, and second, we also realized that different customers, thankfully we have a lot of customers, but then everyone, or if not everyone, they had different interpretations of the same regulation, and they wanted us to implement the solution in different ways. So that created a struggle for us. Of course, what we have done now is we formed a common team. This team looks at the regulations that are coming in. They try to understand it, and whatever is relevant for us, try to create a standardized solution. So thankfully, we have a standardized product, and if we are proactive enough, I think we are in a position to provide a solution to our customers much before it is needed. We in fact also have reached out to the regulator to see if we can be involved at an early stage, where we can understand from them what are they thinking and are able to design the solution proactively. But that's the thought process, that's the direction, there's a long way to go there. You talked about RegTech. I think two areas where RegTech comes into picture, that's my personal opinion. One is the standardization, because there could be, for instance, one of the things that is there now is the key fact statement, so that everyone has to provide. Now, a RegTech solution can be there, and that's what we've seen in some advanced market, that the data is sent to that solution and they create report, or they check the transactions, or you send the transaction to them and they check and give you a value or a score or whatever. So that's how those are the basic thoughts. And of course, what's very important is the speed you talked about. The architecture of the solution has to be such that making changes is easier. An example that comes to my mind is when the COVID struck, and then when there was a need to provide the moratorium. And we were required to do that for hundreds of customers within weeks. And thanks to the solution that we had, which was configurable and hence was able to provide flexibility, it was possible for us to attend to that requirement pretty fast in a couple of weeks or maximum couple of months. So these things become very important, Hardik.
Got it. If I just continue on the theme of regulatory changes, and Jitesh, if I can, call you in, there have been a lot of changes and a lot of proposed changes in the regulatory environment. There's ECL norms, there's climate risk, there is, this liquidity risk, guidelines. How have you seen, and given that you've seen the global markets, you've seen India, how do you see the difference in what has been the experience of Indian financial institutions in implementing or, managing the pace of these changes?
Thanks, Hardik. Good afternoon, everyone. So we have seen quite a bit of changes in regulatory environment in India. Yes. Am I audible? Yeah. So we have seen quite a bit of changes in the regulatory landscape in India. But we also have to see from the perspective that the banking and financial sector has been growing. There has been reduction in NPA, there has been growth in profitability, capital, etc. It's there. So broadly, what we are seeing is this regulatory evolution is required for financial stability. This is required for financial stability perspective and also for fostering of growth in the sector. And RBI has been very proactive in this aspect. We see three key drivers for regulatory change, where regulator is responding to macroeconomic fundamentals, some of the policy directives, which is there. Secondly, what we see is where there is a required to be an alignment with the global regulation. And thirdly, where regulator is trying to strengthen risk management, compliance, etc. within the financial sector. So if you look at from this perspective, there has been changes to liquidity, there has been changes to risk weights and all. A couple of years back, I think so, there has been a tier-based regulation for NBFC, which has been brought on due to increased, importance of NBFC in this sector. In terms of harmonization to global standards, there's a lot of work happening in IFRS 9, IFRS 17. IFRS 9 has been implemented in NBFC, but it's, the final guidelines for ECL are going to be released for India for banking, and there would be a lot of focus on model risk management in that, which is not still there to that level in case of, from an NBFC perspective. And there are a lot of guidelines which have come in to, strengthen risk management and compliance. So you have been guidelines on operational risk management, servers talking about third-party risk management, cyber risk, information security risk, operational risk resilience. There has been guidelines on compliance automation. There has been, guidelines on, draft guidelines on model risk management. So a lot of these guidelines, there have been recently changes to fraud risk management guideline where, EWS focus has shifted from just, not just loan to all other facilities. So there's been a lot of changes to strengthen in, and all this is required to, maintain the financial stability from that perspective. The other thing I think so what you ask about is how can, banks and financial institutions adapt to these changes and how they are doing it. So there are two or three things, banks or financial institutions which have to adapt to changes, they do it well. first thing, they keep themselves abreast of all the changes, what is happening, what they need to prepare. And sometimes regulatory expectation from each of the regulated entity is not the same. It is different, so you need to be aware. They invest in people. There's a lot of attrition risk in this thing. You need to specialize, upskill, train people, that is there. Third thing is what they also do is they do their scenarios, they do their stress testing to understand the impact of this regulatory changes on their portfolio and their operation. And the fourth and most important thing, they invest in technology. The technology which is agile enough to adapt to these changes in quick time. So that's what we are seeing from a technology perspective.
Got it. I think you meant
No, but just to add, while there's so much technology going around and all the banks are investing so heavily, so I think you also asked how are, and Jitesh answered, how are banks equipping themselves, right? So one of the interesting things around the world is that banks are going to the tool which, the old-fashioned tool, which is a telephone. So increasingly, and we see this around the world, so when customers initiate a transaction, of course, all the email and the straight-through processing and all of that is there. Banks are asking their staff to make a phone call to the customers in person to verify the transactions, and especially where account changes are involved. So just to say that while we are moving ahead in technology, we are also, there's this manual physical element which is coming center stage now. So increasingly, and not here or there, but across geographies.
Can I ask you a question? I recently saw a report which BCG had brought about the tech spends of banks in India versus outside the world. And it talked about that India spends about 5% of its of the OPEX. Of the revenue, and globally banks spend 7 to 8%. Do you think this is a right indicator of evaluating? And two is, do you think globally banks who spend more have lesser ops risk and lesser credit risk compared to banks which spend less? Do you generally believe India is spending lesser?
So I wasn't expecting a question for myself, but I'm happy to answer it. So yes, our report actually says that Indian banks are spending about 4 to 5% of the revenue versus the global banks are spending about 8 to 9. I think the difference is, and that's what we've looked at the comparison. The difference is, if you look at the run the bank spend, it's more or less similar. I think it's the change the bank spend that's materially different for us versus the global peers. So that's where I think a lot more can be done. I think global banks have taken the step forward in terms of adopting Gen AI, in terms of being a lot more on analytics. I think analytics is being used differently in India versus the global banks. Global banks use a lot more analytics on the risk side, on the compliance side, on fraud, AML, monitoring. I think we've used a lot more analytics on the credit side, and we are far superior on the analytics side on the credit risk front. So that's where I think the difference is.
I think also that has to do with the replacement of a lot of the old technology of a lot of the legacy banks in West has. Indian, if you see the tech stack of the banks is about 15 years, max 20 years old. Some of the banks in US have 40-year-old technology.
Yeah, that's the other difference.
That is also the legacy replacement, also high cost.
Yeah, and that's also one of the reasons, and the previous panel, someone mentioned about it. The ease of integration of fintechs with the current, legacy institutions or banks is much more easier compared to, global institutions. So even though fintechs are, 5 years, 10 years, ahead of time than the legacy banks, it's still far more superior and easier to integrate compared to the global experience.
True. And also, if you see, the global banks are far more internationalized than Indian banks. So IMF said that last year alone, in 2023, there were 3,000 new trade regulations, 3,000. So I mean, it's obviously humanly impossible to keep up with them. So when you're operating in different geographies, different compliances, different regulators, I mean, it all adds up.
Well, if I can just continue with you, and I think Jitesh mentioned an interesting point. I think technology is important, but equally important is the talent front, right? and you gave me an interesting fact about some survey. Would be happy to share that. But what's your experience in terms of building the right risk and compliance function in banks, and how are they evolving in terms of not being a back office support function, but taking center stage in a lot more institutions now?
So of course, one is, there's a technology aspect, but just focusing, so what's happened, and I've seen it, during the course of my career, is that the risk and compliance have, like you said, they become center stage. They have a voice, and they are, they have sometimes the loudest voice in the room when you are taking credit decisions and so on. So as far as risk goes, the biggest change that has happened, I think, is to do with independence. And again, this is uniform across geographies, across continents, in different countries, that the risk function is being given the independence to make decisions. So that is on the risk side. And on the compliance side, similarly, compliance is now, it's almost in every bank, they have to have the freedom to be able to ensure compliance. And it's also been made a joint responsibility. It's not just the responsibility of compliance. So this compliance culture, all regulators are talking about the tone from the top, and the board gets involved in the compliance, and the compliance policies have to be board approved. So with all of that, I think risk and compliance, of course, they're critical, but they also are participating and doing a lot of the heavy lifting in the decision making.
If I can ask one question, I think a lot has been said about regulatory, compliance, risk is being, a tick mark that has to be done, something that needs to be done. But then there is also a real balance sheet or a revenue opportunity. Climate risk can be viewed as a compliance or a risk management tool, but it can also be looked as a real business opportunity to be baked into the pricing, the underwriting, and also open new pools of financing. And you've had a very good run in terms of building the green finance portfolio. What, if there's any learnings that you can share with the
I think you raise a very important point, and I think building climate risk or ESG has to still take center stage in India. While we all talk about it, I think there is an realization has also dawned on entities, but I think it is at different stages of evolution in different organizations. We started this journey long back, and we started this journey because we had partnered, IFC was and is our equity partner in the organization, and they have an excellent framework to assess climate risk and related ESG risks. And what we realized was that like we evaluate credit risk, ops risk in every transaction or every proposal, I think we created a policy to also evaluate climate risk or anything related to that for every transaction. And so for every transaction in certain parts of our business, we started also evaluating where does the transaction stand in terms of its impact on climate risk. Based on what we got as an output, we created different governance structures in terms of evaluating the transaction and monitoring it over the life of the transaction. It also led to a situation where we stopped looking at certain transactions. Also, it led to a situation where our funding got delayed in certain transactions because we wanted the client to bring about that change in the way the client was setting up the unit before we started funding the project. So I think somewhere we have to make it as one element which needs to be checked and evaluated like we do credit risk or ops risk or some of the other IT risks in transactions. And based on which we need to decide the way forward. And that is something which we are trying to take forward in all transactions within the organization. Your other point on can we really differentiate on pricing? Because if you look at, transactions for banks or lenders, the risk on climate, on what they do is very little, but it is more about the projects which they fund. But India is a very, very competitive market, extremely competitive. Sometimes we wonder whether lenders fully factor in all the risks before they price the transaction. So in such a scenario, to build a differentiation on account of this on pricing is tough. While we try to do, but it is tough, to be honest. And I think we as an industry have to evolve to coming to that stage and factoring in climate risk in our pricing also. So while in terms of evaluation, we are doing it, but in terms of pricing, I think we are finding it really tough to do that.
But it's interesting, you need to embed, sorry, Gaurav, you have a point.
No, I just wanted to mention on the international loans, when you are lending, say, in foreign currency, there now the banks have moved to risk-based pricing. I mean, so you have something called sustainability-linked loans. And when you have sustainability-linked loans, you can agree KPIs with the borrower so that if they meet the certain KPIs with respect to emissions or reduction, carbon reduction, and so on, then the pricing comes down actually. So in that sense, you are seeing that internationally, and it is only a matter of time. I think it will come to India also.
You raise an important point. How do you embed the risk management practices across all the different functions, right? Whether it's credit, whether it's monitoring, pricing, all of them. And Sudipta, we were discussing about this. You've been very passionate about building a risk and compliance culture in the organization. If you can share some thoughts around that.
So I think the most important part about building a risk and compliance culture within the organization is first thing is the tone at the top. In the sense that what is your senior management team, including the CEO and the, sort of the board members talking down to the entire team, and the fact is that is the organization's sole objective is, revenue growth and only top line growth, or is the organization's objective is balanced growth, which takes risk into account? So in a way, is the top management saying that, risk is our middle name, basically? What this, first thing is tone at the top. The second thing is that sort of propagating a sort of sensitization of, and obviously risk we have, credit risk, reputation risk, ops risk. Yeah, ops risk, then we have climate risk, as you asked. Now, one of the issues that we have is that at many times, the risk, especially the credit risk and the risk teams are sometimes a little detached from the rest of the organization. At times, I would not like use the word secretive, but there is a little detached. One of the ways of doing this is to mainstream this organization, right? And mainstream the risk and compliance organizations. And one of the ways of doing it is that when you are doing risk, credit risk, cybersecurity risk, ops risk, climate risk projects, induct people from business into those projects, make it as much cross-functional as possible, so that there's a cross-pollination of risk, that sort of the risk culture or the risk sensitization that happens across the system. Third thing, you only understand risks when your skin gets burnt. That is the real way when real managers understand risk, when you actually go through a situation yourself. Now, one of the ways is that, but it is difficult to sort of, especially for younger managers, it is difficult for them to get the full grasp of risk, right? And many of them are top-line driven, many of them are, especially managers in distribution. One of the ways to do that is to do risk simulation exercises, right? And that gives them because still I find that many people still, after many years in banking and financial services, do not assimilate the fact that banking is an adverse ratio business, right? And simulation exercises actually go a long way in sort of sensitizing those young managers about risk. And last but not the least is avoid an adversarial culture. The senior management always needs to avoid an adversarial culture with the group of people who are interested in managing risk in the organization. It has to be, they should say business, risk and business go hand in hand. Actually, they're parts of the same P&L. Right? So as long as that is made very, very clear, I think it goes to build a risk culture in the organization very, very strongly.
Yeah, and I think you mentioned it right. I think credit risk, fraud risk, operations risk, a lot of this can be merged alongside the business teams, right? I think there's one potential area of risk, cyber risk, which is still not viewed as a business priority. Parag, if I can come to you and if you can share light, how do you see this as a technology solution provider? Do you still see this as a CISO and an IT priority, or are you starting to see that become a business priority as well?
Hello. Yeah, definitely. I'll say not seen it as a business priority yet myself, because these do not come up in discussion so often, except when there is a compliance or some challenge happens. But I want to make a couple of points. What really worries us, because we've been there in this field for more than 3 decades, and today it's a very, very connected world. The number of integrations that we used to have a couple of decades back was very handful. But today I think we are connected with 40 plus fintechs, because that's what the customers expect us to do, and it does give the business value. But in matters of cybersecurity and all, we all know that we are as good as the weakest link. So even if one player is not complying or there is a challenge, the entire ecosystem can be impacted. Adding to it, this is the speed at which now things are expected to be done. We talked about the speed of changes, of the regulatory changes, even the business competitiveness increasing. So in fact, a lot of time we are asked to move fast, deliver things faster. And while we are looking at that, how to increase the speed of our releases, but again, what adds to the worry is that speed at which we are moving. Are there some shortcuts being taken? And because the world is so connected today, it is really, so I think this needs definitely a far more serious discussion. I don't know what happens, but I'm told that in developed markets now, cybersecurity risk is definitely an agenda on the board meetings. It must be happening here. I don't know what happens here, but I think that's the kind of importance that needs to be given to this.
I'm mindful of time. Jitesh, last question before we open up for a couple of audience questions. You've seen the transition of, the analytics models from being, basic to, very advanced AI models. Are you starting to see that Gen AI is playing an important role on the risk and compliance side as well? We've seen that a lot happening on the customer experience side. We've seen that happening on the marketing side. Are you seeing Gen AI being an important enabler for risk and compliance as well?
So we have seen a lot of Gen AI use cases emerging in risk management. We particularly in SaaS believe Gen AI can revolutionize risk management. So in multiple ways, you look into three ways basically how Gen AI can impact risk management is, first, the kind of value it brings to, data mining. So, traditional search engines, you search and they give you a list. But here with Gen AI, you get curated, precise answers. So just see the importance. You can monitor your internal and external data. It can give you curated information. It can give alert in real time. based on that data analysis. So its application for cybersecurity, its application for fraud risk, investigation is immense. The second way, Gen AI impacts risk management is it democratizes access to risk data. You need not know a lot of complex algorithm. Anyone sitting can query a database and get an information. A customer analyst can query and get insight into the trends. It can also bring a lot of productivity as far as risk modeling is concerned, converting codes in different language, generating model documentation, and also is helping in generating effective communication, means how you communicate with customer, what offers to give that to your customer. So we have seen a lot of Gen AI use cases emerging. We have seen in Europe, particularly emerging in big way. We have started to see trends in it. India is in its nascent stage there, but we do believe Gen AI will have a lot of impact. And also, one of the other use cases we have seen emerging is generation of synthetic data. In servers talking about simulation, stress testing. So those are some of the use cases which we have seen emerging for Gen AI from a global perspective.
Hardik, what I'll say is that we just filed a patent about 3 weeks back on our Gen AI use cases, which we call Human Lifestyle Index, where for our microloans customers, what we're trying to do is that we've trained the LLMs to actually build a standard of living index in rural households. So we take a picture of the outside of the house, we take a picture of the inside of the house, and then the LLM actually can identify whether there's a refrigerator, whether there is concealed wearing, whether there is a fan, right? Whether it's a painted house, whether it's an open brickwork painted house or a cemented painted house. So we have trained the LLM to do that. And we've just deployed it into production, and it's working really well.
Fantastic. On that note, let me open up to the audience for a couple of questions. If there's anyone.
On using Gen AI in risk management. So one of the issues in Europe that the banks face is explainability. So in the bank, what happens is, if everything is fine, it's good. But when something goes wrong, then you have to explain why you took a particular decision. So with Gen AI, sometimes it's a black box. But of course, you get the right decisions most of the time. But when you don't, you're not able to say why. So that is one challenge that we're also looking to be overcome.
I didn't mention it, but explainable AI is a very key concept. In geographies like Europe and all, there's a lot of focus on that, explainable AI. So we are working with our customers, we are working with our regulators to bring that explainability to AI. So that is one of the key themes SAS is working with its customers on.
Fantastic. If there are no further questions, thank you. Okay.
One last question.
Please.
I want to ask about risk. Basically, from what little bit I know about risk, is about not getting the wrong customer, right? All of us spend a lot of time figuring out how not to get the wrong customer. But there's another risk, another error called beta error, where you miss a good customer. How many banks really do research on the customers you missed out, who've gone out and done very well with some other bank? And there is a risk associated with missing out a good customer. Why is it not taken into account when we calculate the overall risk? Thank you.
You've asked a very relevant question. In all banks, there are committees, risk committee, every committee, which evaluates when the case goes bad. But there is no committee which evaluates why credit or risk declined a proposal, which later on did well. I have not come across any committee in any bank which does that. So in a way, in certain functions, in certain things, we do it, but I think that has to still evolve. Because the accountability is on both sides, not to allow bad case to go through, but also not miss out on a good opportunity.
Yeah, as a promoter, very often we make that call which banks are not doing. When a borrower is a promoter, sometimes he knows when he lends money to a customer, he takes the call that the cost of losing is much lower than the cost of benefit. That concept is not coming into the bank side, whereas entrepreneurs, we do it all the time.
In the next session, there are a lot of bankers who will be sitting out here. They will be able to answer this question much better than I can.
All right. On that note, thank you, everyone. Thank you for a great discussion.
Thank you, all dignitaries.